Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Edge Group. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
Dan, what's your view on the growth versus the value argument in our current positions now?
Look. Obviously, we've sort of touched on the sectors that tend to do well in an inflationary environment, which was, obviously your cyclicals and values and sort of the duration and growth stocks not doing as well. And obviously, in the short term, we're seeing that the value sector outperform growth, and it has done by a very significant margin over the past 6 months. But overall, from a medium term to long term perspective, I do think superior returns can be generated by investing in high quality businesses that can maintain and grow their earnings streams over the long term. And that obviously falls into the growth basket versus the value factor, where these are lower quality businesses, more volatile in earnings streams, and earnings are more exposed to the underlying economic cycle and the macro settings, not just upon the position of the business in the industry. And obviously from a growth perspective, from a quality perspective, we have embedded that factor in our investment philosophy and our portfolio construction process. Where over the long run we have a bias towards allocating towards quality and growth businesses and sectors, because I think over the long run those businesses will do well. So once again, in the short term, it's about just actively managing the portfolio and recognizing the fact that things have changed. I mean, we've had these settings that have favored growth since the start of the GFC, where we've had sort of unusual monetary policy settings, and now because of the pandemic and then some geopolitical issues, the value sector has come to life after 14 years. But once again, it's the growth of that sector is fragile, and as soon as that sort of dynamic changes, that sector will go out of favor again. And once again, where do you go? You go to quality businesses. So I think it pays to be biased towards that factor, which is what we tend to do in our portfolios over the long run.
So really over the next 12, 24, 48 months, that you're really looking for more of a value-orientated portfolio, and then once it's kind of settled and established, then you'll probably jump back into the growth aspect of it?
Look, it's our primary investment philosophy is quality at a reasonable price. So it has to be a quality business. Now, we're not going to chase some of these high momentum businesses. You got your small business, single earning stream, or financially challenged business that just happens to do well. So that's not within the mandate or the style of the portfolio. But what we're trying to do is recognizing the fact that times have changed. And what we've tried to do is just shift the portfolio and introduce exposures that are still good businesses, and that also as a benefit tend to do well in this environment, and hence the inclusions of the likes of Computershare, Cube, and Suncorp into the portfolio. We've had Elders, which is one of the cyclical businesses that we added last year. So these businesses will do well, but it's not businesses that you want to hold for the very long term. So, for example, CSL is probably the highest quality businesses, one of the highest quality businesses on our market, and it hasn't had a great time over the last 12 months. It's pretty much gone sideways, whereas the market's gone up. But because we've got confidence in the quality of that business, we're happy to hold it through this sort of phase of the market, because we know we're happy to, if nothing changes, we're happy to hold that business for the next 10 years. But for some of these other cyclical businesses that need the macro to go their way, well, we're not happy to hold them for 10 years, but we're recognizing that we need to basically diversify the portfolio and enhance diversification just to get through this current phase. And then when things change, we can reassess.
And I think that's something we've been saying to clients lately, Martin, is one of my go-to lines: when the facts change, so will my mind. But also, taking into account the fact we're going into a completely different environment. Sometimes you do need to change your mind about the particular stocks you're holding and how that economic environment might impact.
It is.
on the
I think
particular
that the energy sector is a classic example where the market's chasing it. It's done fantastically well in this year. I think up about 25-30% because oil prices have gone up because of what's happened overseas. Now, the structural headwinds for oil are still there in terms of fossil fuels and renewables and the long-term change in the demand pattern. So it's not something that you want to be holding for the next 10 years without sort of a lot of ups and downs. So you got to see what you're chasing in the market in short-term moves because they're in the headlines and those earnings are not sustainable. So if the oil price was to go back down to $80 again, which it may as well do so in the future, well, the share prices and the earnings are going to go down with it versus CSL's earnings or Woolies' earnings are not going to go down to that extent, all things being equal, obviously.